I want to talk about bonds from a different angle, because as you've pointed out, this 3-month, 10-year yield curve inversion, right? Most people think it's kind of boring. It may be. But it's only happened 3 times in the last 25 years. And all 3 times, it didn't work out well for the U.S. economy.
So my partner, Kevin Karan, and Steve Lerrett, that work on our team, did some research on the curve. And what we found was that this indicator is a very good one when it comes to figuring out when there will be a recession. But the recession could happen 15 months later. So that is one thing. The other thing is that the stock market, it's very hard to predict when the stock market will go down. But what we noticed is that the top of the stock market happens roughly about 1 month to 15 months out. So we would, at this point, just look at this indicator as a carbon monoxide detector. That doesn't necessarily...
I mean, is it screaming or is it just starting to beep?
It's starting to beep. You have to check the battery. We have to also be aware that it's not timely so that we know to get out immediately. It's not a good trading indicator. But overall, it's telling you that the U.S. economy and the global economy is decelerating, and that stocks, when compared to bonds, may not be as attractive as investors think.
Because I love history, but I will say this, pushing back a little bit on these things, because this is an environment with a very easy Fed. We've got this trade war going on. We've got all this other stuff happening that we don't really have an historical precedent. So I wonder if those 3 times in the past, do they matter as much?
Well, they may matter because it could affect the real economy, from capital investment to lending when it comes to banks to profitability of financial institutions. But you're correct. Never have we seen an environment within interest rates where you have German bonds on the 2-year selling at a negative 70
Well,
basis
it's
points.
as we show, our number of the day, one day last week, was 12.5 trillion, because that's the total value of debt. France, Sweden, Switzerland, Japan, Germany, that is yielding negative. It's insane.
It is insane. And so this is an indicator that this is telling you that the global economy is going to continue to be very sluggish and slow. Inflation expectations are going to continue to be lowered. But overall, what market optimists are looking at is the earnings yield in relationship to this low interest rate environment, and saying to themselves, I can get a better return within the stock market. So at this point within the cycle, although we are cautious when it comes to the yield curve, we're still modestly overweight equity risk, in particular within the United States.
Because when I look across the board, and we're going to do more about this on the show tomorrow morning, I look across the board, I mean, not only is everything up, but the weakest economies in Europe, Italy and Greece, their stock markets are the best performing in Europe. Bitcoin back above 11,000. The Chinese market has been on fire the last couple of weeks. Everything's up.
Yeah, this is the perfect thing, conversation to be had, because just because the monetary authorities across the globe could do what they've been doing doesn't mean that they should have been doing what they're doing. And what I mean by that is that you're starting to see asset inflation even in the most speculative fringes of the market. And this is something that overall, if this continues over the next 18 months, could be quite troubling.
So do you see the ability for the U.S. stock market to continue on?
We do, for the time being. We do expect perhaps a 4 to 6% annualized return over the course of the next 3 to 5 years. But you're going to have a lot more volatility. If there is an adjustment within interest rates, meaning a reverse where the curve goes higher, then that could potentially be a major headwind. But right now, we still continue to think that there could be a market melt-up over the course of the next 6 months.
It has been, in some respects, the most hated bull market in American history, but it just keeps going. I wonder if some of it has to do with just the shrinking pool of assets that's out there as well.
You need aggregate demand across the globe to decelerate or actually go negative, and you haven't seen that yet.